Hello and welcome to the BamCam podcast with your hosts, Jack Burnette, Alison Castellano, and Adrian Castellano. We've got a full house today, and I'm Wendy McConnell. Well, hello, everyone.
Hello.
Hi. Yeah, it's the whole team is here today.
It's a little tight over here.
It's a full house, and Allison is about ready to deliver baby number 2.
So
Yes.
all four of us are right here.
Yeah.
Close
All four of
quarters.
you. Yes, absolutely.
Hopefully, we're going to get through this episode without Allison going into labor.
Yes.
I sure hope so.
That's always a risk.
I hope so, too. We can all keep our fingers crossed about that. Adrian, I wanted to ask you really quickly. When you're in the middle, often people feel like that's the worst. I actually think being in the middle is the best because the people on the side, and again, it depends on the people, are so concerned that you're not going to have enough room that they squeeze themselves out so much that you get plenty of room. So do you have plenty of room?
I have plenty of room, yeah.
Surrounded by good people.
We have good leg space over here.
You are
It's much better than
surrounded
the
by
airplane.
good people. There you go. That's always a plus. So what are we going to be talking about today, guys?
We're going to talk about financial jargon. In our industry, we use terminology amongst ourselves all the time, and we just assume that everybody knows what we're talking about.
Yeah.
And that often is not the case. We sometimes get stopped and say, please explain that to
Yeah.
me and so forth. So we thought we'd talk about some things today that may not be on the tips of our listeners' tongues and help them to understand what some of these terms mean.
Yeah.
Yeah, we're talking terms like fiduciary, inflation, annuity, but what exactly do those terms mean? They get thrown around all the time, and sometimes it feels like the financial world is speaking a completely different language than the rest of us.
And we are.
And I know a thing or two about speaking a different language, but today we're going to break it down in plain English. No complicated finance talk, just clear, easy to understand explanations to help you make better money decisions and feel more confident about your financial future.
Yeah. So I think the first term that people, and you see this, we see it on advertisements on television, but is fiduciary.
Yeah, that one comes up a lot, fiduciary.
So yeah, this is a term that comes up, like Allison mentioned, a lot, especially when you're looking for financial advice. You hear it, you see it on the commercials, on the radio. A fiduciary is someone who is legally required to act in your best interest.
Correct.
Yeah. And so basically being a fiduciary means that I'm sitting on the same side of the table as you, and I'm not making recommendations based on what's good for me, what's going to make me the most money. I'm making recommendations because you asked for guidance, and it's my job to act in your best interest.
Historically, financial advisors in our industry, I'm going back to the days that we might have been called stockbrokers.
Mm-hmm.
And we worked on a commission basis, and that does have an inherent conflict of interest. And so when you're compensated by way of commissions, that is not a fiduciary.
Yeah.
It might be instead of acting in your best interest, it might be a suitable interest standard and things of that nature. So today, advisors that work on a fee-based or advisory-based model, no commissions, just advice for a fee, are fiduciaries.
Yeah. So, Dad, is it fair for a potential client or a client even to ask their advisor, are you a fiduciary?
Yes.
Yeah.
Yes. And potentially an advisor could act as a fiduciary on some parts of their business and have another part of their business where they would technically not be a fiduciary. They may be still acting in the client's best interest, but for example, life insurance is compensated almost exclusively in the form of commissions paid.
Yeah.
And so, we are a fiduciary on 99% of the work we do, but we do occasionally sell some life insurance and things of that nature. And so that does pay a commission.
Yeah.
And we point that out to the client.
Yeah.
So basically what you're saying is if you're not acting as a fiduciary, it doesn't necessarily mean that you're a bad person.
Yeah. And it doesn't, it doesn't mean that you're taking advantage of a client. It just means that technically you don't meet the definition.
Yeah.
I have always, and we as a team always tried to recommend to our clients what's in their best interest. I've never thought and focused on how we're compensated or whatever. I just let that kind of take care of itself. We explain to our clients how we're compensated so that they understand and we're transparent about it. But we want to be a fiduciary. We want to always act in our client's best interest.
Yeah.
So even when technically, for instance, on a life insurance case, that we technically would not be considered a fiduciary, we're still only making recommendations that we firmly believe are in the client's best interest.
Exactly. So let's get into another term. Inflation. We hear that one a lot. It's in the news a lot. And inflation is simply the decrease in purchasing power over time. Or put another way, it's when prices go up and your dollar doesn't stretch as far as it used to.
Yeah, we've obviously all been feeling that one lately at the grocery store. That's the big one. The gas pump, housing prices. Our money just doesn't stretch as far, like Alison mentioned, as it used to.
Restaurant prices, et cetera.
Yeah.
Generally, the baseline that the Federal Reserve targets as a normal rate of inflation that is considered to be stable prices is a 2% annual raise of prices across the board, and that would be applied evenly in different sectors. So housing prices increase 2%, food prices increase 2% annually, and so forth. So that's why when you have kind of normal or low or minimal inflation, and we have a period of time, say from like 2005 through 2020, where inflation was very, very low and prices were considered stable, prices were still higher in 2020 than they were in 2005.
Yeah.
But not significantly. They might have collectively gone up, 15 or 20% collectively during that 15-year period.
But we didn't feel it like we're feeling it right now.
That is correct.
I've got an example to kind of explain inflation and a little bit easier to understand terms. Imagine you're at the grocery store with $10 and apples cost $1 each. That means you can buy 10 apples. Now, let's say a bunch of extra cash gets pumped into the economy, like we saw with some of the stimulus checks over the last couple of years. And let's say it's 40% more money. So instead of $10, now you have $14. But here's the catch. The number of apples hasn't changed. There's still 10 apples. So instead of apples costing $1 each, they're now $1.40 each. That's inflation.
Correct.
And since we love math so much, let's take this whole equation a step further. What if the supply of apples decreases, maybe due to supply chain issues, shortages, production slowdowns? Now, instead of 10 apples, there are only 7 apples available. Solve for X. Everyone still has $14 in their hands. What happens? The price per apple jumps to $2. Now, that's inflation and supply and demand at work.
Correct.
Yeah, and that's kind of what we've seen in our economy, especially since 2020.
Right. We often get asked what caused the spike of inflation. And the simple terms are there were too many dollars chasing too few goods and services. And so how do we get too many dollars? Basically, our government printed them in simple terms. When COVID came in the early spring of 2020, our government asked the economy to shut down. And our politicians said we have to create stimulus to take care of people who cannot work.
Mm.
And so they created this across the board stimulus package that that helped bridge the gap for people that were staying home and idle and not working. And that included things like PPP and other programs, and in early, actually went into effect in summer of 2020. And that was fine. By, parts of the economy were starting to reactivate, after a couple of months. And so it was not 2 weeks to slow the spread
No.
by any means, but it was slow to recover. Our politicians, in their so-called wisdom, decided, well, if one stimulus program wasn't enough, was good, we're going to pile on and do more.
Mhm.
And so Congress basically passed 3 more stimulus bills
Mhm.
that flooded more dollars into the economy, and not across the board to all people, but to basically special interest.
Mhm.
But it threw dollars into the economy. So it created this huge influx of dollars. This can be measured and seen very easily. The Federal Reserve reports on the money supply. It's called M2. And you can see a huge spike in M2 in 2020 and 2021. So it threw all these dollars into the economy. The number of goods and services actually were somewhat limited, because with the economy slowdown and supply chain problems, particularly with international products and things of that nature, you remember all the ports of entry being slowed or
Yeah.
shut down in some cases. So you had all these dollars chasing actually a reduction of available goods and services, and that bids up the pricing. Just in the example of the apples, instead
Yeah.
of being 10 apples
Yeah.
available, there's 7 apples available, but yet there's more dollars available to buy apples.
Mhm.
Yeah.
So as a result, the price of everything went up. And so inflation spiked up to about the 8, 9, 10% level. Some
Mhm.
pockets of inflation went even higher. And some sectors of the economy. And so as a result, we're now paying the price, because
Yeah.
when inflation comes, it does not generally reverse and go back to where it was.
Yeah.
It goes
Yeah.
back to kind of a baseline, which that baseline is that 2%
Yeah.
growth category. So that 8 or 9% inflation that we had for one full year becomes a permanent base.
Yeah. Yeah. So this is where the Federal Reserve comes in. One way to try to slow inflation is by raising interest rates, which we have seen over the last several years as well. That makes borrowing money more expensive, slows down spending, and helps prices to stabilize.
Right. It's designed to slow down the spending so that it slows the economy and allows the spending to slow, and so everything kind of catches up. And they're targeting that 2% rate.
Yeah.
Inflation today is running at about 3%.
Yeah.
So it's not at the level the Fed wants. So as a result, the reduction of interest rates is slower than people anticipated.
Yeah. So let's get into another term,
Okay.
annuities.
Okay. Annuities means a lot of different things, actually. The actual word annuity technically means a stream of regular payments.
Yeah.
So you think about it, when you if you have a pension
Yeah.
that pays you a monthly check at retirement and pays you every month until you die, that is an annuity.
Yeah. I remember when I was studying for my exams to come into this industry, when I read about annuities, I was like, oh, this sounds like my teacher's pension.
Yeah.
Correct.
And there are all different kinds
Absolutely.
of annuities.
Yeah.
2 of the big ones, fixed annuities and variable annuities. Fixed offer a guaranteed payout with, we'll call it limited surprises. I don't
Mhm.
want to say no surprises, but
Yeah.
limited surprises. And then you have variable annuities that are tied to the market, meaning that your payout can go up or down based on how the investments inside perform.
Right. Well, and you're getting a tad ahead, because what annuities also refer to a certain type of product.
Yeah.
So
Mhm.
in addition to just
Exactly.
a description of a type of payment. So an annuity as a investment product is basically an investment contract that can only be issued by an insurance company.
Mm-hmm.
So it is, it's not issued by a bank. It's not issued by an investment company. Only are issued by insurance companies. Annuities offer some tax advantages in that you can get tax deferral
Mm-hmm.
inside of an annuity. It's part of the way the laws are, and the fact that they're issued by an insurance company that allows that. It's not tax free. It is tax deferred, similar to the way an IRA or
Yeah.
a 401k, 403b type account works. And we're going to talk about those accounts
We
too
are,
here
yeah.
shortly. But and what's interesting is that often advisors may sell an annuity inside of an IRA.
Yeah.
And what's ironic about that is that that's a redundancy of tax deferral.
Yeah.
It's no
Yeah.
no
Does no good.
advantage.
Yeah.
Yeah.
For
Yeah,
that.
we've seen that several times. And some people love annuities because they provide this reliable income. Others don't love them because they have high fees, surrender charges if you take the money out early, and they can be really complex. There's so many different ones out there. It's a really complex vehicle.
There's a lot of these products that offer different types of riders associated with them, and they get layered with all these. Every rider has an additional cost. So
Mhm.
annuities, not always, but generally, are a higher cost form of investing, but you may have some protections or guarantees. So an analogy that you may want to look at is, first of all, if the guarantees or protections built into the annuity fit your needs, then it may be an appropriate product for you. You need to understand what that is. The annuity, if it has these guarantees and protections and it meets your needs, it's almost like having property and casualty insurance on your investment.
Yeah.
So, and you're paying a premium in the form of higher fees, just like you pay a premium on homeowners insurance on your house
Yeah.
to protect your house. So it is, it may be appropriate. Where my biggest complaint about annuities is that in our industry, there's a lot of advisors out there that sell annuities. Oh, well, first of all, you don't have to be licensed with securities licenses and that we have
Yeah.
to sell annuities. So insurance agents can sell annuities that are not, and they're not securities licensed. And so it's all you need is an insurance license, which is relatively easy to get.
And are they acting as a fiduciary when they sell it to you?
Absolutely not.
Exactly.
And so because annuities pay high commissions, and generally to the advisors, and a lot of it, people in our industry have built their entire business on doing it, selling annuities, and it's an expensive form of investment, and they are not for everyone. And so, but some people are not securities licensed, so they're limited in their scope on what they can sell and offer to clients. So they lead with that. So if you have annuities out there, you want to make sure that it's the right product for you, because you're paying a premium in cost.
Yeah.
You may not see it, but it's there, and it's, you're definitely paying a premium.
You need to fully understand it. That's one of the things that we see is that holders of annuities, they just don't fully understand the product that they have.
Invariably, when we sit down with a prospective new client, And if they own annuities, I don't think I've ever been able to have one tell me why they
Yeah.
own the annuities and what is it, what are the features and benefits
Mhm.
of that annuity that compelled them to buy it, other than this guy said,
This
They
guy
were-
said I needed it.
They were
yes,
convinced.
yeah.
They were
So,
convinced.
Yeah.
and so it is, I'm not a huge fan of, of, of annuities. I have used them sporadically in our practice, and it's only under certain circumstances.
Yeah.
And then I want to make sure that the client understands why they have it
Mhm.
and what it's designed to do
Yeah.
for them.
Maybe those are good questions that a client should ask if someone is, trying to convince them that they need an annuity. Is this a good fit for me? Why is it a good fit for me? Just so you understand why it's being recommended.
Correct.
Yep,
Correct.
exactly. All right, let's move on. Next topic, we're talking about qualified retirement accounts. So let's break those down.
Okay. Well, qualified accounts basically that's a kind of a catch-all of category of accounts, and it generally means retirement accounts.
Mhm.
So your 401k plans at work, or it may be a 403b, or if you're in the federal government, it might be the thrift savings plan, the 457 type government plans. They all work somewhat the same, very close. It includes individual retirement arrangements, IRAs,
IRAs, yeah.
and also Roth IRAs fall into that category of qualified money. So typically you have a tax deferral. So money is that goes into those accounts has except for Roths, money that goes into those accounts is not been taxed,
Mhm.
and then that's grows inside of that account, and then the government taxes it when you withdraw it from the accounts.
Yeah.
Exactly.
So basically what you're saying is you contribute with pre-tax dollars. So you
Correct.
kind of lower your taxable income now
Get a current
Correct.
tax break.
and you get a current tax break, but you'll pay taxes when you take out the money later
Correct.
in retirement.
So let's say someone that's making $80,000 a year,
Mhm.
and they're putting let's say 6% into a 401k, and their employer is matching that with 4%. Well, 6% of their pay is not taxable. So instead, that 6% of 80,000 is $4,800. So their taxable income for the year is 80,000 less the 4,800. And so as a result, they reduce their taxable income. So they get a tax deduction for what they put into the plan. Let's go down the road, and that $4,800, let's say they're withdrawing, in retirement, $40,000 a year after working for an
Yeah.
entire career, and they're taking 40,000. Well, that 40,000 then becomes taxable income.
Yeah.
So what you put in is taxed. The growth of it is taxed as well.
Yeah.
So any gains you've had in there will ultimately be taxed, and you pay the tax when you make the withdrawal.
Yeah.
So, so it works the same way for a 401k, 457, 403b, or an IRA. Roth accounts are a little different because
We're
you
going to
don't
get into that in just a minute. You're
Okay.
jumping ahead,
I'm jumping ahead.
It's a passionate topic.
Yeah.
Absolutely.
Yeah. So, but keep in mind the government does put limits on how much you can contribute each year, and there are penalties for pulling the money out too early, typically before age 59 and a half.
Yeah, the 2025 contribution limit for a 401k or 403b is 23,500, and for an IRA is 7,000. But there are opportunities for catch-up contributions if you're 50 and up.
Correct. And so and there's other little types of plans that have other slightly different rules. SEP IRAs have different rules. Simple plans, which are anything but simple, but that's the acronym. And so for that, but they all have different contribution levels and everything, but the tax deferral mechanism works the
Yeah.
same way.
Yeah.
Now, one thing that we have seen before is that when people change jobs, they end up with a trail of 401ks
Yeah.
or whatever their
Little
savings
buckets
plan
of money
was.
in
Correct.
different places.
Yeah. So when you do change jobs, you have options.
Correct.
You can leave the money where it is
Yep.
at your previous employer's 401k plan or whatever. You can roll it into your new 401k if your new company allows for that.
Right.
You can roll the money into an IRA that could give you maybe more control and more investment choices. Or you could cash it out, which is not typically recommended.
Typically not. So,
Because remember, there are penalties if you take the money out early before age 59 and a half.
right. And it's important when you move money from one plan to another, to avoid a taxation event, that you not take possession of the money.
Yeah.
It is, if you go custodian to custodian in a direct, what's called a rollover, that's not a taxable event.
Yeah.
So when we work with clients and we're helping them and they choose to consolidate old retirement, employer retirement plans, they do it for the sake of convenience. They like to be able to see it consolidated all in one spot. So and that they don't have these multiple little small buckets of money, and also making sure that the right hand and the left hand are operating in sync from an investment strategy perspective.
Exactly.
Yep.
So typically employer plans have very limited options as far as their investment, their menu of investment choices, as opposed to an IRA. The advantage is that the employer plans are generally very inexpensive.
Yes.
But having little buckets, and you're leaving in your wake if you change jobs. So somebody, let's say in their first 15 years of their career that works 4 or 5 different jobs, could have 4 or 5 different buckets of money here and there.
Yeah, we see it often with somebody that had a job for a year and a half. It's a small amount, but they completely forgot about it.
Yeah, and they forget about it. It's out of sight. You learn, you're not getting statements. You're not getting these things. It's easy to forget, and it might be $8,000 or $10,000 or $12,000. Those cases generally, I think it's best to consolidate so you don't forget about something and lose track of it.
Exactly.
Yeah. So let's kind of jump again into another topic. And Dad, you kind of teased this a little bit.
Correct.
Terms that you hear thrown around, especially when discussing these qualified retirement accounts, are Roth and traditional. And if you have a 401k or an IRA, you've probably heard about the choice between Roth and traditional accounts. The main difference is about when you pay your taxes.
Yeah. So Jack mentioned this a little bit earlier. With a traditional IRA or 401k, you're contributing with those pre-tax dollars, meaning you get a tax break right now, but you'll pay taxes when you withdraw in retirement. So you lower your taxable income now, but you pay those taxes when you withdraw the money later in retirement. And with a Roth IRA or 401k, you contribute with after-tax dollars, meaning that you pay taxes up front, but your money grows tax-free and you won't owe the taxes when you withdraw it in retirement.
Correct. So I'm a big fan of Roth money, especially for younger people.
Yes.
Where you remember I said that on a traditional IRA, traditional 401k, the gains are also taxable. So if you have 30 years worth of embedded gains in a retirement plan, that's all going to be taxed in an ordinary plan. If you have a Roth and you have the gains are not taxed either when you take the withdrawal. So that's the biggest advantage. And when you have time and discipline in an investment strategy, those gains can be very substantial. So a young person that can put money into a Roth, that's a great thing to do. And whether it's a Roth 401k, if their employer offers it, and we see more and more employers that offer that as an option. And it's more impactful for a 30-year-old to put money
Yes.
into a Roth
Yeah.
401k than a 50-year-old.
I can tell you
Yeah.
right now, with Allison being a former teacher and with me being on TV as a meteorologist, we were not in a high tax bracket.
That is true. That is true.
So it made sense.
Yeah.
That is true.
Yeah.
So generally, if you're going to be in a lower tax bracket in retirement, a traditional 401k may be, or traditional qualified money may be better. If you're going to be in a higher tax bracket in retirement, Roth money may be better.
Yeah.
So that's, kind of the nature. And I think the younger you are, the fact that you can shift all those gains
Yes.
over time makes Roth more compelling.
Yeah.
It's a huge
Now there
difference.
is something to consider. You can convert a traditional IRA to a Roth IRA. You'll owe taxes on the amount converted, but to determine if this makes sense for you, you really need to talk with a financial advisor.
Correct.
It's not an ideal situation for everyone.
Correct. So for example, let's say you're sitting there and you're in retirement
Mm-hmm.
and you have $1 million in qualified money and you'd like to consider a Roth conversion. So let's say you're taking out $40,000 out of your savings and you're also drawing Social Security and you have income of, let's say, $80,000 a year. Let's say you may also have a small pension. Maybe let's say your income's $100,000 a year in retirement. If you wanted to convert 100,000 of that 401 or that IRA to a Roth, your income is going to go up to 200,000. So all of that income is going to be taxed at a higher tax bracket because of the progressive nature of the taxes.
Yeah.
And it may not make sense, and you may not have enough time left in your life to really get the benefit of the tax-free growth
Yeah.
of the Roth. It looks more compelling on the surface than when you actually start looking at actual numbers.
Yeah.
But it sometimes is a more compelling way to go.
Yeah.
Um,
But it's important to know that option is there. It's not the best option for everyone, and you really need to consult with a professional.
Agreed.
That's where we come in.
Agreed.
Yeah.
Yep. And we're happy to help with that. So we hope that this helps clear up some or provide clarity to some of these terms that you hear out there.
Yeah. There's a lot of terms, but when you understand them and how they impact your money, you're in a better position to hopefully make confident financial decisions.
Yeah.
And if you found this episode helpful and we can help you in your pursuit of financial wellness, we would love to do that. You can reach out to us at info@iterfw.com. That's ITERFW.com. You can reach me directly at Alison@iterfw.com. Jack is Jack@iterfw.com. And Adrian, you guessed it, Adrian@iterfw.com.
We made it easy.
Well done, guys, everybody. Fantastic job. So thank you for putting that information out there, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the BamCam podcast with Jack Burnette and Alison Castellano from Iter Financial Wellness, a financial advisory practice at RFG Advisory. To get in touch with us, visit today's show notes or go to our website at www.iterfinancialwellness.com. That's ITERfinancialwellness.com. And please click the follow button to be notified when new episodes become available.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Information here may be provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither our guests nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of our guest. They do not necessarily represent those of RFG Advisory, its employees, or its clients. This commentary should not be regarded as a description of advisory services provided by RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, LLC, RFG Advisory or RFG, a registered investment advisor. Private Client Services and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place. RFG Advisory is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of RFG by the Commission, nor does it indicate that RFG or any associated investment advisory representative has attained a particular level of skill or ability.